Hello, good morning. Welcome to the Addenda series where I will give you a quick but detailed overview over one specific addendum. So here we go. We are going to talk about the seller financing addendum today. Very interesting document. It is not used very often, at least in my experience, but it is still very interesting. So, seller financing, just like the third party financing addendum and the loan assumption addendum, you're going to find the box to either check or not check for the seller financing addendum in paragraph 3. This is going to discuss a type of financing for the buyer to purchase the property from the seller. And we've talked about this before, but you can purchase a property with cash. A third party, meaning a bank, is financing the loan to purchase this. A third party bank is financing the loan to purchase the property, or the loan assumption addendum, or a loan assumption where the current mortgager is refinancing or financing the same loan but with a different name on it. Or in this case, where it is seller financing, meaning that the seller is the bank here. So there is no credit check with a bank. There is no down payment with a bank. There is no underwriting terms with a bank. There's no upload your documents with the bank, get a pre-approval with the bank. There's no bank. The seller is the financer. So that's why it's called the seller financing addendum. The only way a seller can finance their own situation is if they own the property outright. That means there is no loan on this house. The seller owns this house 100%, and they can now, on their own terms, allow the buyer to buy that property from them and they will finance it. Okay. So, that seller to be able to finance the buyer, right? They need to do a credit check. So that's what A is talking about and B. What does the credit look like? How are we going to verify the credit? And then we're giving the 7 days after everything is looked at for the buyer or seller to terminate due to that credit score. Okay. What is the promissory note? How much is the property going to be on a note for? Okay. And then what is going to be the interest rate? The seller comes up with this, not the buyer. It is negotiable, but it's seller financing, not buyer financing. So the seller is saying, let's say the example is 100,000 and we want the down payment to be 20%. So that'll be 20,000 down payment. We are going to have a promissory note for that 80,000 at an interest rate of 6.7%. Okay. All of those details, when the payment is going to be paid. Is it going to be paid yearly, monthly, quarterly? How are we making the payments? Who are we making the payments to? How much are those payments going to be? What is the interest rate? What is the down payment? What is the loan amount? All of that is on this document. Again, because it is negotiated between the seller and the buyer, and the seller has to be okay with it because the seller is financing it. So literally the seller is saying, John Doe, I will sell this property to you for $100,000 with 20% down at a 5.6 interest rate. You will pay the house off within 10 years with monthly payments of $3,500 a month. I don't know. I'm just making stuff up. So if that math doesn't math, don't blame me. But that's literally what this is saying. And the seller is the one that's saying this amount with this term, these terms will make me comfortable. And they will receive that residual income every month because the house is paid off. So once the loan is paid off, those 10 years are done with now. I've received my 5.6% interest on top of my 100,000. Now I can officially transfer the deed and everything. There will be no deed of trust. There's no foreclosure coming in. Everything is now yours. And now you, the buyer, has now paid off the property. Okay. You see seller financing again only when the seller owns their property outright. But typically, the buyer that uses seller financing does not want to go through a regular bank. That's number one. Number two, they cannot qualify for a regular bank, meaning their credit is too low or the DTI is not working. Maybe it's someone that's 1099 and doesn't report their income correctly. So they don't make enough money per their taxes, so they need someone to just finance it based on maybe a P&L statement or something like that. But either way, that's what this document is used for, and hopefully that helps.